It's 2:17 a.m., your phone lights up, one number, silver 73. 39, then blink, it's gone, up, down, sideways like a slot machine with the lever ripped off. And gold, the safe metal, slips under 5,000, snaps back, it slips again. That's not a market, that's a warning siren. Because when hard money starts moving like a drunk driver on black ice, it's not volatility. It's stress fractures in the system, the kind you don't see until the bridge collapses. Somebody is yanking the wheel, hard, and they're doing it on purpose. They'll tell you this is normal, a healthy pullback, a technical correction. No, this is the same trick they always use. They pump it, they whip it, they shake out the public, then they lock the exits. And the people who lose? The sleeping herd, the retirees, the people who did everything right, saved, planned, trusted the rules. But here's the dirty truth. The rules are not laws of nature, they're policies. And policies change overnight. What you're watching in gold and silver isn't a price chart, it's a heart monitor. And the patient is the dollar, and the line is starting to wobble. You felt it, didn't you? That little squeeze in your chest. That what if that hits at night. Good. That's your instincts waking up. Because the people running this system, they do not care about your comfort. They care about control. They don't lose sleep over your 401k. They sleep fine on your money. Now listen closely. That 73, 39 print in silver and the slip under 5,000 in gold is not random. It's a message. The plumbing is clogging, the pipes are rattling, and the pressure is building. The insiders move first. They always move first. And when they move, they create whipsaws. They create chaos because confused people freeze and frozen people don't protect themselves. Now let's talk about the machine behind the curtain, because the whipsaws in silver and gold slipping under 5,000, that's the smoke. Here's the fire. U.S. federal debt, $56 trillion, not billion, trillion. And that number was recorded through February 3rd, 2026. Now pause. Say it out loud. $38 trillion. You can't picture that. Nobody can. So imagine this, a line of $100 bills stacked end to end around the earth, not once, not twice. So many times your grandkids would die of old age before you finish counting. That debt isn't sitting still. It grows relentlessly, like mold behind the walls. And now here's the part they won't say on television. Debt doesn't get paid with good intentions. Debt gets paid with currency, and currency can be created. That's the cheat code. That's the whole game. Print, borrow, roll it over, print again until something snaps. And right now, you're watching the snapping. Here's the uncomfortable math. Every new dollar created makes every old dollar worth less in real life. At the grocery store, at the pharmacy, at the gas pump, and if you're 55 plus, you feel it because you're living off what you already built, which means inflation isn't an abstract chart, it's a thief, a quiet thief. A thief that takes a little, then more, then suddenly. Too much. Now watch how they manage your emotions. When gold and silver run, they call it a bubble. When gold and silver drop, they call it proof. Heads they win, tails you lose. It's a casino, and the house writes the rules. Gold recently had a historic sell-off, one of the worst in decades. Then buyers rushed in and pushed it back above 5,000. That rebound wasn't confidence. That was panic buying. That was people lunging for lifeboats after seeing the Titanic tilt. And silver is smaller, thinner, easier to shove around, so it swings violently when big money yanks the rope. That matters because silver is the canary in the coal mine. When silver is calm, the room has oxygen. When silver is screaming, the air is changing, and you just heard it scream. Now, let's talk about the safety net. FDIC, you've heard it 1,000 times. Your deposits are insured, and yes, the headline number still says $250,000 per ownership category per bank. But let me ask you a question the sleeping herd never asks. Is the insurer big enough for the catastrophe? Because FDIC doesn't insure your deposits with a magic wand. It uses a fund, a real fund, measured against insured deposits with a reserve ratio, targets, restoration plans, paperwork, but none of that changes one simple fact. Total deposits in the U.S. system are enormous. Around $7 trillion as of late 2025. So do the picture. Imagine a tidal wave, that's deposits. Now imagine a bucket, that's the backstop. If the dam cracks, what happens? They ration, they delay, they process, they tell you to stay calm, and then they change the rules. This isn't a theory, this is math. If the system has trillions in deposits and the backstop is tiny compared to that ocean, then FDIC is not a magic shield. It's a promise, and promises break when the numbers get too big, and the numbers are now too big. Now connect that to what you just saw. Silver prints 73, 39, then whipsaws. Gold slips under 5,000, then whipsaws. That's the market screaming. Liquidity is thinner than you think. When liquidity is thin, the big players can shove price. And when they shove price, they can trigger forced selling, margin calls, stop losses, liquidations. That's how transfers of wealth happen. Not with a press conference, with a whip, with a sudden drop that makes regular people say, "I can't take this." Then the price snaps back, and the public is left with regret. Let me show you the playbook in plain English. Step 1, they create a scare, a headline, a rumor, a source familiar with the matter. The herd panics. Step 2, they slam price, fast, so your stomach drops, so your hands shake, so you sell for relief. Step 3, they reverse it quietly while you're licking your wounds. That's why it feels like whiplash, because it is. And here's the part that should make you angry. They call it a free market, but it's not free. It's managed. And when it's managed for them, not for you. Now imagine this, and you wake up to a bank holiday. Not forever, just for the weekend, just to stabilize things. You remember hearing those words in history books, but now it's your town, your branch, your money, and all you can do is watch talking heads tell you it's fine. Meanwhile, your neighbor is at the ATM at dawn, hitting the same button over and over, and it keeps saying the same thing, unable to process. That's what the sleeping herd never practices. The moment the screen says no, they never imagine it because it's uncomfortable, because it sounds extreme. But the system doesn't fail in a dramatic movie scene. It fails in small denials, small limits, small temporary changes. Now bring it back to your real life. Retirement isn't a spreadsheet. It's groceries. It's medication. It's grandkids. It's the roof that suddenly needs repairs. It's the car that suddenly needs a transmission. If your dollars lose power while you're on a fixed income, you don't just tighten your belt. You cut essentials. You skip. You suffer. And that is exactly why gold and silver matter to people your age. Not because you want excitement, because you want stability in a world that's becoming unstable. And if you're wondering about the next phase of control, look at the direction of travel. More digitization, more tracking, more know your customer, more anti-money laundering, more rules that treat you like a suspect for moving your own money. Whether they call it a CBDC, a digital dollar, or just upgraded rails, the goal is the same. More visibility for them, less privacy for you, more switches they can flip, more knobs they can turn. And once those switches exist, they will be used. Imagine this. You're at the pharmacy. The prescription is ready. The clerk smiles, then frowns at the screen. Your card isn't going through. You laugh, because it must be a glitch. Then you check your banking app, a bright banner. Account under review. No crime, no warning. Just a button that says contact support. And support tells you to wait. That's what control looks like, not handcuffs. A hold, a delay, a shrug. Now, here comes the trap. Imagine this. It's a Tuesday morning. You're at the gas station, card in hand. You tap. Declined. You try again. Declined. Not because you're broke, because a temporary rule hit your account. A spending limit, a compliance review, a national security measure, and you stand there, 65 years old, watching people argue with a cashier like it's a bad dream, and you realize your money isn't money, it's permission. That's the trap. They're building a world where savings are trackable, throttleable, programmable, where you don't own dollars, you rent access to them. And if you step out of line, if you say the wrong thing, if you buy the wrong thing, if you move your money at the wrong time, they can freeze you with a keystroke. They won't call it confiscation. They'll call it consumer protection. They'll call it stability. They'll call it anti-fraud. But the effect is the same, control. Who gets squeezed first in a control system? The people who follow rules, the people who are polite, retirees, because retirees have something the system wants, stored purchasing power, your lifetime of work, your pension checks, your IRA, your bank balance, all sitting there like a pantry full of food in a town where the shelves are empty. So governments do what they always do. They change the rules on the pantry. They tax it. They inflate it away. They reform it. And the most dangerous part? It happens slowly until it happens all at once. Look at the fiscal direction. Just 2 months into fiscal year 2026, the U.S. borrowed $439 billion. 2 months. That's not a budget. That's a bleed out. And when a country bleeds out, it distracts. It spins. Then it reaches for your wallet. Here's where most people make a fatal mistake. They think, I'll react when it gets bad. But by the time it's obvious, it's too late. In a crisis, you don't get to shop calmly. You get shortages, premiums, delays, limits. Now tie that back to metals again. Gold and silver don't whip like this in a healthy world. They whip like this when leverage is unwinding, when forced selling hits, when the big players are repositioning, and the public is used as the shock absorber. Silver printing 73, 39 and snapping back, that's a flare shot into the night sky. It's telling you, price discovery is breaking, and when price discovery breaks, you don't get fair value. You get whatever value they allow you to have. Now, the exit, not a meme, not a fantasy, an old rule that still works. If your wealth sits inside someone else's system, it's not fully yours. That's counterparty risk. If your retirement is a bank promise, a brokerage promise, a pension promise, an insurance promise, a government promise, then you're living on layers of paper, and paper burns fast. But a bearer asset, that's different. It doesn't need permission to exist. It doesn't need Wi-Fi. It doesn't need a bank's mood. It just is. It sits there, silent, heavy, honest. That's why central banks hoard gold, because when currencies wobble, gold doesn't call anyone. Gold doesn't file paperwork. Gold doesn't ask for approval. Now let's get real about silver. Silver is the wild cousin, smaller market, more industrial demand, more prone to squeeze, more prone to whip. That's why it moves like a speedboat, while gold moves like a battleship. So you don't treat silver like a lottery ticket. You treat it like supplies, because silver is what people can actually use and understand at street level. Gold is the vault. Silver is the day-to-day. Together they remove counterparty risk. They remove the middleman. They remove permission. They make you your own central bank. Say it again. Be your own central bank. Now, I'm not telling you to do something reckless. I'm telling you to stop being naive. Stop thinking the system will protect you because you are a good citizen. The system protects itself, always. Now what happens next? After a violent print like 73, 39 in silver, and a slip under 5,000 in gold, the next move is rarely calm. It's usually another trick, another shake, another headline, because the system needs you confused. So here's the insider truth. The whipsaw is the message. It says the big money is positioning for a different world, a world where cash loses, a world where promises get tested, a world where the average retiree gets told, sorry, your account is restricted, and temporary becomes permanent. Imagine this. Your pension arrives, but it buys half of what it used to. Imagine this. Your savings statement still shows the same number of dollars, but those dollars buy less every month. Imagine this. Your bank tells you there's a withdrawal limit, not because you did anything wrong, because everyone is withdrawing. Imagine this. You go to pay for a repair on your home, and the contractor says cash only, or he says silver, or he says, I don't trust the banks. And you realize the world has shifted, quietly, while the sleeping herd argued about nonsense. In that world, the people who are prepared will look calm. Not because they're lucky, because they planned before the panic. They built lifeboats before the iceberg hit. Now they'll try to scare you away from the lifeboat. They'll show you a dip in gold, a dip in silver, and they'll smirk. They'll say, see, it's risky. Then they'll inflate your groceries, your insurance, your medical bills, but they won't call that risky. They'll call it the new normal. That's psychological warfare. They want you scared of the lifeboat, so you stay on the ship. Now let's get practical. If your wealth is digits on a screen, you're trusting a chain of institutions and systems. Chains break at the weakest link. Physical gold and physical silver cut links out of that chain. They don't solve every problem, but they solve the one problem that ruins retirees, being trapped in someone else's system when the rules change. Picture two retirees, same age, same neighborhood, same income. One trusts the system completely, all paper, all promises. The other has a portion in physical metal. Not as a gamble, as a reserve. A shock hits, a banking headline, a sudden policy, withdrawals delayed, limits imposed. The first retiree panics because every door is digital. Every door requires permission. The second retiree breathes because some of their wealth is outside the maze, outside the leash. That calm is priceless. Now I can hear the objection. What if metals drop again? They can, they do, especially silver. But ask the deeper question, what are you protecting? A monthly chart or your purchasing power for the next decade? Retirees don't have the luxury of starting over. Inflation eats runway. So the goal isn't to time the perfect bottom. The goal is to stop being 100% exposed to paper promises, to stop being all in on the same system that is drowning in debt. When gold slips under 5,000, it's not the end, it's a signal. It tells you there's stress. It tells you the casino is shaking the table. And when silver prints 73, 39, and whipsaws, it tells you something even more important. The market can move faster than most people can react, which means in a real crisis, you won't have time. That's why you prepare before the temporary measure, before the new program. Because once those words appear, the game changes. And it changes against the public, against retirees, against savers. Now I'll leave you with one last picture. Imagine this. It's Friday night. Markets are closed. Your bank app spins, loading, loading. Then a message pops up. Services temporarily unavailable. And on the news, they tell you not to worry. They tell you it's routine. They tell you it's precautionary, and you sit there staring at a screen realizing your life savings are behind glass and you don't have the key. Now ask yourself, in that moment, would you rather own promises or would you rather own something real? If you want to survive what's coming, subscribe to Currency Rewind, because the sleeping herd will keep watching the headlines while the corrupt system rewrites the fine print. And remember this, when gold and silver start moving like a casino, it's because the house is nervous. And when the house is nervous, it doesn't pay out. It locks the doors. So decide now, before the doors lock.